So, hello everyone, a very warm welcome to all of you on Ecoholics YouTube platform that is there to cater the needs of RBI Grade A, Grade B aspirants. Now, a very warm welcome to all of you in our today's live session. And from the thumbnail itself, you could have guessed that we will be seeing one of the core topics that is related to RBI itself. Every each just wait for a minute. Every other day we discuss few things that is related to RBI or that is related to banking sector in general. But in today's live session, we will be discussing. Just wait. Okay, so in today's live session, we will be discussing one of the topics that is directly related to the RBI functioning. Okay, and that's why it is important. So it is directly related to RBI and RBI functioning, because if you see on a daily basis we discuss few things, interesting topics, important topics, but there is a possibility that those topics might be related with RBI directly or indirectly, or might be related with the banking sector. But our today's, you can say, our today's topic is going to be directly related with Reserve Bank of India functioning. So now let's go ahead and let's see what we have with us to discuss today. So I hope the screen must be visible to you people now. Okay. RBI's Liquidity Management Framework 2.0, enhancing market stability and monetary policy effectiveness. Now, see, so liquidity management framework, what it is, you will ask me, sir, ये है क्या चीज? So obviously now see, in a economy we have liquidity, we have money in circulation, we have multiple ways of having liquidity in the market. Liquidity means the availability of currency, the availability of funds in the economy. Funds equal to liquidity. The availability of funds is equal to liquidity. Now see, so liquidity in the economy get regulated by Reserve Bank of India. That is the first thing that all of us should be knowing. That RBI is the one who manages the liquidity in Indian economy. RBI is the one who formulate monetary policy and implement it. And via the implementation of its monetary policy, RBI tried to maintain the liquidity in the Indian economy, as well as try to maintain the inflation in the economy. At the same time, try to have a growth perspective as well. So everything, whatever RBI's do, the monetary policy formulation, then the implementation and other economic operations, that is there to check the liquidity condition, to check the funds that is available in our economy. So there is a framework that RBI is having at this point of time to manage the liquidity that is there in the economy. Now RBI has constituted a committee to recommend some update if there is some update required in their liquidity management framework. So they have constituted a committee. Now that particular committee has given its recommendation, and now we will see what are those recommendations, because now see, we are preparing, all of us are preparing for RBI, Reserve Bank of India Grade A, Grade B profile. Now see, RBI's sole purpose or the sole activity, one of the sole purposes and sole activity is liquidity management. And if something is happening in this regard, in this domain of Reserve Bank of India, that it becomes extremely important for us to have a great or comprehensive knowledge of what is happening in Reserve Bank of India liquidity management framework. Now let's see, let's move ahead. Now see, so LMF liquidity management framework is operational since Feb 2020. So it is operational. This management framework, this liquidity management framework is operational since February 2020. Now in recent development, RBI constituted an internal working group. Whenever an internal working group got constituted, you don't require to know the chairmanship and other things. Okay? In case of internal working group, we don't know that we should be knowing the chairmanship or something like that. Then Now this internal working group has submitted its recommendation, and the goal of those recommendations are improve efficiency, at the same time predictability of liquidity management. Now let's see the first thing. What is RBI liquidity management framework? You will ask me, sir, okay, already I have given you a brief idea what it is, but let me tell you once again. So it is a toolkit, it is a framework, it is a methodology, you can say, used by RBI for what? To manage cash in the banking system. It means managing liquidity in the banking system, steer short term interest rate, how they can control the interest rate in the economy, and ensure smooth monetary policy transmission. So, whatever RBI is trying to set a monetary policy in its bi monthly monetary policy statements, so for the smooth transmission of their decisions, they require a proper framework or a toolkit, that is the liquidity management framework. Core mechanism. So it relies on liquidity adjustment facility. The core mechanism, if someone will ask, if in grade B, phase 1 or phase 2, you will see, if they are asking what is the core mechanism behind the RBI's liquidity management framework, then that particular core mechanism is liquidity adjustment facility, ठीक है, which contains repo and reverse repo operations. It operates via a corridor system with repo rate at the center. Sir, what is this corridor system? So you must have heard about the marginal standing facility and the standing deposit facility, or you can say reverse repo rate, and in between we have repo rate. Okay, this is the entire corridor. This is the entire corridor within which the liquidity adjustment facility works. ठीक है, this is the entire corridor within which the liquidity adjustment facility works. In between we have repo rate, that is a floor rate. Then the upper ceiling is marginal standing facility. This is the highest ceiling, you can say, under which a bank can lend from RBI. Now SDF and reverse repo rate is the lowest, you can say, ceiling is the lowest part of the corridor, via which RBI can squeeze money from the market or squeeze money from the banking system. In between we have repo rate. So this is the corridor system. Under this corridor, under this liquidity adjustment facility corridor, this management framework works. Okay? And what is the key operating target? Repo rate, or you can say the weighted average call rate. Okay? What is this? Now you will ask me, sir, what is the weighted average call rate? So if you see in a money market, okay, in a money market, we have call rate market, we have notice market, we different kind of markets are there. Okay? So in money market, call rate is that particular interest rate in which the interbanking lending happens for a single day. Let me repeat it. Call rate is the interest rate that is there in a call rate money market, via which interbanking banks lends to each other for a single day. That is the call rate. Okay? And when we'll take the average, we see all the volumes of the call rate transaction, and then we'll take the weighted average. We call it weighted average call rate. So what RBI is trying to do, RBI is via its, you can say, via its monetary policy statement, monetary policy framework, or monetary policy steps, RBI tried to regulate the weighted average call rate only, because that is a rate that got transmitted in money market, eventually in capital secondary market, eventually in capital market and the primary market of secondary market as well. Okay? Sorry, eventually the primary and secondary market of capital market as well. So if RBI regulates the average call rate, weighted average call rate, then the entire market will get impacted. So via the monetary policy statement, via various liquidity management, you can say, steps that RBI take, RBI is tried to influence this particular, you can say, this particular interest rate only. That is a weighted average call rate. Repo rate is there, that directly impacts the weighted average call rates, and then the weighted average call rates impact money market, then eventually the capital market, and then the entire Indian economy. Okay? Other tools that we have under the liquidity management framework is open market operations, cash reserve ratio, and the statutory liquidity ratio. Moving ahead, now we'll see the recommendation. We saw what is this liquidity management framework is all about. Okay? What is its functioning? So we saw that it's a toolkit, first of all, that manages cash in the banking system. that try to regulate the interest rate, and that try to ensure the smooth monetary policy transmission. Okay. Then we saw that liquidity adjustment facility is the core mechanism that is there under the liquidity management framework. Then we saw the upper ceiling and lower ceiling. Okay. Then we saw that the WACR is the something that RBI tried to regulate via its core, via this framework. Then other tools we saw. Now we will see the various recommendations of what this internal working group committee has recommended in the recent or in the concurrent liquidity management updation. What is the updates that is required? What the internal working group has recommended? Now we will see. First thing what they have recommended is shift in shift in liquidity operations. ठीक है? They have told to discontinue 14-day variable rate or reverse repo rate operations. Now you will see in future that RBI will be discontinuing the 14-day variable repo rate or reverse repo rate operations. Why? Because banks are reluctant to lock surplus funds for 2 weeks. Because now see, the amount of transactions that happens, or the transaction amounts, the transaction that is happening in this repo market, it's huge. Okay, the amount is huge, and even for a single day if these transactions are happening, it matters a lot to any banking entity because the amount is huge. Okay, so banks are reluctant under a 14-day. If you see, just let's take an example of repo rate. Now RBI is lending. Okay, RBI is lending. Now, even if under the reverse repo rate, if RBI is getting money from the market, any banking entity don't want to pass their money or to deposit their money with RBI for a 14-day long period. So banks are reluctant to lock surplus funds first of all for 2 weeks. The difficulty in forecasting liquidity due to erratic government cash flow and current movements is also one of the reasons. So what they have said that discontinue the 14-day variable repo rate or the reverse repo rate operations. What they have proposed, shift to weekly main liquidity operations. So whatever the liquidity operations RBI is having for a weekly, for a weekend or for a week of a time, they have told that we you should stick to this only. Use short-term fine-tuning instrument, smooth the daily and short-term liquidity fluctuations. Okay? So what they have said, instead of going for a longer period of time, you should be sticking to a short-term fine-tuning operations. You will see in RBI's future liquidity management operations that RBI will be avoiding having long-term liquidity management operations, and they will be sticking to the short-term fine-tuning instruments. Okay? Now, the second recommendation, what they have said is the WACR retained as operating target. Weighted average call rate is something that is there as a operating target. First of all, keep this thing in your head. Okay? Now, RBI has said that retained. Okay? Via repo rate operations, or via any monetary policy statement or operations, RBI try to transfer the impact of repo rate via WCR to the economy further. Okay? WCR is something that RBI try to manipulate or try to control. Now, what they have said, okay, your operating target should be WACR only. Now, RBI will continue using WACR as the operational target for monetary policy. Via monetary policy, they will be targeting WACR only, what they used to do earlier. Now, also they will do the same thing. Challenges. Overnight call market activity has declined significantly. What is the challenges? Because overnight call market activity has declined. Now, if call market activity will decline, then obviously WACR will get impacted because that is the interest rate in which uh, that is the interest rate that the call market is utilizing to lend. So obviously, what why government is saying now here, the committee has said that they have noticed that the call market operations are going down. So you need to work on that. Narrow interest rate corridor discourages interbank trading. Banks increasingly prefer RBI liquidity windows over market based transactions. Banks are trying to evade from this call market and notice market. Okay? They are trying to be they are trying to be more dependent on RBI liquidity windows. So, here what they are saying, try to change the pattern, try not to follow this kind of pattern. Okay? Stick to a short term fine tuning instrument. Then the or you can say the overnight call market is getting overnight call market transaction is getting reduced, so try to revive it, and then try to decrease the dependency of banking sector on RBI's liquidity windows. And what they should be doing, they should be having more dependency on market based transactions, that is call market, notice market, etc. Recommendations: adjust corridor width to balance rate stability with market vibrancy. This corridor width is the same thing that I was telling you. Okay, the upper is the margin standing facility, then repo rate, and then the standing deposit facility or the reverse repo rate. RBI liquidity management. Now we'll see the next recommendation. Now, reserve requirements and average mechanism. Now, what is the issue over here? They saw that the cash reserve ratio, that is something that CRR is something that they keep with RBI, okay, the banking entity, that is there in this second schedule of RBI Act 1934. They're required to keep some amount of CRR, and other cash reserves they required SLR, CRR is something that is required. Now, what they have noticed, that banks often maintain more than required reserve on a daily basis, okay, which reduces the intended stabilizing effect. So they are having the reserve with them, but they are maintaining it more, okay, they are maintaining it more. They are trying to maintain, they are trying to over maintain it, okay. So what is happening because of this? It is reducing the intended stabilizing effect. What they have suggested: introduce a lower daily reserve floor. On a daily basis, you can say, okay, on a daily basis you can have a less reserve in context of CRR or something, to encourage arbitrage, to reduce call rate volatility, and enhance liquidity distribution. But obviously CRR is something that is there, that is important, that they should be maintaining with themselves. So what they should be doing, instead of regulating these kind of reserves on a daily basis, minimum reserve requirements and averaging over the maintenance period, they should be saying, okay, CRR is something that is, just I'm giving you a hypothetical situation, is 10%, okay. On a daily basis you can have less CRR as well, but on a 14-day basis, 14-day average basis, if you will take the 14-day average, then your CRR should be more than or equal to 10%, okay, on a 14-day. If for a individual day we will note down the CRR that you have kept with you, and when we'll take the average, it should be more than or equal to 10%. On a daily basis, lower daily reserve floor can be accepted, but yes, on a longer period of time you should be having the same amount that we have recommended. So this is something what they have said: reserve requirement and average mechanism. Instead of daily requirement, prudently seeing the daily requirement, you should be transferring yourself to the average mechanism. Stand alone primary dealers. Now these are the NBFCs. SPDs are kind of NBFCs. First of all, they deal in government securities only. They acquire government securities from primary market, from the money market, and then they sell it in the capital market. So this is what the primary dealers do, okay. So these are the NBFCs, first of all, that particularly work in the sector government security. They deal in government security. Their principal business is dealing in government securities. Now, stand alone primary dealers, so they participate in call money market, first of all, okay. But the reality is they are not allowed in the marginal standing facility. They haven't the access of MSF, okay. We saw that the liquidity adjustment facility works in a corridor. The upper ceiling is marginal standing facility. In between we have repo rate, and the lower ceiling is the SDF, that is standing deposit facility or reverse repo, you can say. So this stand-alone primary dealers is not having access of MSF. That is the reason they heavily borrow from the call money market, okay, call money rate, and that causes a volatility in the market because they don't have any other resource to borrow, okay. So they borrow from the call money market. It occasionally breaches the corridor limit during tight liquidity conditions. There are conditions. Now, see, they are not allowed to get the loan under MSF. So what they will be doing? They will be getting loan from the call money market, and if they are not getting it, then what they should be doing? They might be getting it on a higher interest rate, that is there in the call money market. So if the liquidity condition is tighter, then they will be getting the funds on a higher interest rate, and that rate can go beyond MSF upper limit. So that is the reason. in a tight liquidity conditions, the corridor limit got breached because they don't have any access of MSF. They're only having the access of repo rate or the, you can say, the or the call money market. Okay. What IIWG recommended, what this internal working group recommended, do not grant MSF access to SPDs. They have it. They said okay, SPDs should not get, the primary dealer should not get the access of MSF, but you should be gradually phasing out the standalone primary dealers from the call money market as well. Now you will see that RBI will be gradually will be reducing the activities of standalone primary dealers from the call money market, and obviously then how they will get the funds, how they will get the money, then provide alternative invest liquidity resources to maintain their government security market role. Okay, this is what they have said. Now the next set of recommendation, and that is this is the last slide. Okay, now structural liquidity surplus. Now what RBI is saying, this, it's been a while that there is a persistent excess liquidity in the economy, and that has caused the weighted average call rate to deviate from the repo rate. Government is setting repo rate at 6%, just in a hypothetical situation. Government is trying to set the WCR at a repo rate, but because of excess liquidity that is there in the economy, it is not getting regulated. Okay? And sometimes it breaches the corridor limits as well, weakening monetary policy transmission. For an example, in the you can say the government is trying to keep the repo rate at 6%. So government is saying, okay, say any banking entity wants to lend money from Reserve Bank of India, then the interest rate is 6%. Now, because there is a liquidity, excess liquidity in the market, in a interbank, whatever the now banks can take. Now see, banks either they will take from RBI or they will take from other banks. Now they will see that RBI is charging 6% for the loans, for the credit, what the banks want, and there is a excess liquidity in the market. Now they are saying that the banks are giving at 5% only because they are having liquidity, because they have having excess liquidity with them. So they will choose to interbank operations. They will switch to the interbank lending, and that is the reason the persistent excess liquidity caused WACR to deviate. The call rate is what? Call rate is something. The call rate is the interest rate that the interbank operation is happening. Okay? Banks are lending to each other. That interest rate we are calling it the call rate interest rate. Okay? And when we take the average, we call it WCR. So WCR is getting deviated from the repo rate. Government is trying to, RBI is trying to keep the repo rate as 6, but WACR is working around 5%. Reason? Persistent excess liquidity. So what they said, enhance liquidity forecasting, increase flexibility in operation tools, and ensure WCR stays close to the policy repo rate to align with the monetary stances. Then we have the corridor width. So we, as of now, we saw what is the corridor width. Okay, we know what is the corridor width. Repo rate is in between. The higher ceiling is MSF and the lower ceiling is SDF. In between, repo rate is there, and this is the entire corridor width that we are having at this point of time. Now, if you see, India's 50 basis point corridor is narrower. If you see what is the, if you see the repo rate is there, then we have the MSF, and then we have the SDF. The entire corridor is of 50 basis point. What does that mean? If it is 6%, then MSF is going to be the minus 25 basis point. Okay? Then you can say that 6.75 is going to, sorry, 5.75 is going to the MSF, and SDF is going to be the plus 25 basis point. It means 6.25 is going to be the SDF. So this is the 50 basis point corridor. Okay? What they are saying, that this 50 basis point corridor is narrower. We need to expand it as compared to other emerging markets. In other emerging markets, if you see, this corridor is wider in nature. We are having a narrower corridor. Okay? Pros is to limit interest rate volatility. Okay? What IWG suggested, what this committee suggested, that conduct an empirical study, see the past year experiences of your, collect data from there, and then evaluate the trade-off. Trade-off means what is the impact you are having on your trade because of this narrower, you can say, policy corridor. Okay? Reassesses the, you need to reassess the corridor width for optimal monetary operations and deeper financial markets. In nutshell, they are trying to say that broaden, try to broaden your corridor. ठीक है, 50 points corridor is a narrower one. Try to broaden it, try to expand it, because if you see the emerging markets in other emerging economies, this corridor is on a wider scale. ठीक है, so this is what the internal working group committees recommended. Now, so this was it, the entire recommendations we saw what is the liquidity management framework, what is the requirement of this, and then we saw why. So it is in operation since the year 2020. Now it's in 2025. So RBI framed a constituted a internal working group to see the updates that is required in the liquidity management framework. Now they have given the recommendations, and when we saw the entire recommendations, and via seeing all these recommendations, whatever the intricate or whatever the technical words we came across, we discussed all those things as well. Okay? And if you want to download this data for free of cost, then you can download it via our app that is available on Google Play Store. You can download all this data for free of cost from there. And even if you want, even if you are having any query or any doubt in regards to the paid content that we provide, then you can reach out at this number. Our academic counselors will provide all the answers of your queries in a most appropriate way. Till then, have a great day ahead. Bye. And do subscribe to our channel and turn on the notification bell, because now the RBI examination is around the corner. On 18th of October it is, and we will be coming up with such interesting topic, right, that is surely going to help you in getting good marks in the phase 1 as well as in the phase 2 general awareness part. So do subscribe to our channel and turn on the notification bell. Now let's meet tomorrow with a new and interesting current affairs topic that is important for your RBI examination. Till then, have a great day ahead. Bye.